Welcome to the world of silver, the misunderstood precious metal that's quietly powering industries and sparking massive investor interest. In early 2026, silver exploded to all-time highs above $121 per ounce, driven by record retail demand, chronic supply deficits, and explosive momentum in futures markets. But then came the pain. Sharp margin hikes by CME Group forced leveraged longs to liquidate en masse. Prices crashed hard, dropping over 40% from the peak in just weeks. Let's break down the key events that created this roller coaster and why many believe silver's next big move is coming soon. First, on February 9th, 2026, CME Group launched a brand new product, the 100-ounce silver futures contract. It's financially settled, cash only, no physical delivery needed. This makes it much easier and more accessible for retail traders and smaller investors to get exposure to silver without handling huge 5,000-ounce contracts. This launch is huge. Record retail demand has been building for months, and this smaller, easier-to-trade size could bring in a flood of new buyers, reigniting the boom we saw late last year. Second, to control the wild volatility, CME repeatedly hiked margins on the main 5,000-ounce silver futures. In January alone, multiple increases pushed margins from around 11% up to 15%, then another jump to 18% on February 6, 2026. These hikes hit leveraged positions hard, especially on low-volume days like Friday afternoons, triggering massive long liquidations and the brutal January sell-off. But here's the pattern. Exchanges often raise margins during extreme volatility to cool things down, then lower or stabilize them once the dust settles. With the new 100-ounce contract live and volatility potentially easing, many expect margin relief soon, which would free up capital and encourage fresh longs to re-enter. Third, remember late November 2025? There was a major COMEX system issue, an 11-hour shutdown or severe trading disruption. Right after that event, silver caught fire and started its epic run-up into early 2026. Disruptions like that often spark panic buying and short squeezes, and we're seeing echoes of that momentum now. Fourth, the January crash wasn't random. Margin hikes combined with thin weekend liquidity led to cascading stops. Weak hands got shaken out, but strong hands, industrial buyers, central banks, and physical demand stayed in. Silver's structural deficit continues, 5 straight years of supply shortages, growing solar and EV demand, and tightening export rules from major producers. Now, as of February 9th, 2026, silver is trading around $80, $82 per ounce after a sharp rebound from the lows. That's up significantly from the recent bottom, showing buyers stepping in aggressively. So is this the bottom, or just another fake-out? Many analysts see this as a classic healthy correction in a bull market. The new smaller futures contract lowers the barrier to entry. Margin hikes may have peaked. Fundamentals remain rock solid, persistent deficits, industrial hunger, and safe haven appeal amid global uncertainty. If margins stabilize or drop and retail floods in through the new product, we could see silver retest $100 and potentially push toward new highs again. Silver isn't just a metal. It's an industrial powerhouse and a monetary hedge. After the shakeout, the stage is set for the next leg up. The time to watch silver closely is right now. History shows these violent corrections often precede even bigger rallies. What do you think? Is silver's time coming back? Stay tuned and don't miss the next move. Thanks for watching.